In a stunning turn of global financial events that few analysts truly saw coming, Japan has just delivered a seismic blow to the stability of U.S. financial markets, triggering shockwaves that are reverberating across the entire economic landscape and forcing investors worldwide to reassess everything they thought they understood about monetary policy, currency dynamics, and bond market hierarchies. At the center of this unfolding drama lies a problem Japan has wrestled with for decades: an ever-expanding mountain of sovereign debt that grows heavier each year, threatening long-term stability and making it nearly impossible to continue borrowing indefinitely without encountering severe consequences. But what complicates the situation even further is the unexpected resurgence of inflation, a crisis that is turning out to be far worse than previously imagined. Households across Japan are being financially squeezed to the breaking point, real wages are shrinking, and the Bank of Japan now finds itself painfully cornered with fewer policy tools left to contain the damage. Inflation in Tokyo continues to hover near 3%, well above the BOJ's modest 2% target, yet wage growth is lagging far behind at only 1.9%, which means the average Japanese citizen is watching their purchasing power erode month after month. It's the brutal scenario where salaries technically rise, but everyday goods grow even more expensive, eventually crushing domestic consumption, the very engine of Japan's economy. Amid this domestic fragility, fears surrounding Japan's debt explosion have conveniently faded from political discourse at the worst possible moment, just as the government prepares to unleash a colossal $120 billion stimulus package amounting to roughly 3.4% of GDP, much of it financed through the printing press. Yet, despite these stimulus ambitions, the BOJ is prioritizing something even more urgent: taming inflation and rescuing the crumbling yen. Their latest communication sent the strongest signal yet that a December rate hike is almost unavoidable, even though Japan's debt-to-GDP ratio has ballooned to a staggering 230%, and exports are buckling under global weakness. This impending rate hike has already begun rattling global bond markets, and among all the countries impacted, the United States stands to suffer the most and at the worst timing imaginable. With the Federal Reserve expected to cut rates in December, incentives to hold U.S. dollars and treasuries are poised to fall sharply. But if Japan raises rates at the exact same moment, it would electrify Japanese bond yields and destabilize the Treasury market. Japanese yields are already erupting. The 10-year JGB has soared to 1.84%, a level not seen since the 2008 financial crisis. The 20-year yield is brushing 2.9%, its highest point since 1998. And even the 2-year JGB has surpassed the critical 1% mark, all unmistakable indicators of a historic pivot. This shift positions Japanese government bonds as direct competitors to US Treasuries for the first time in decades. A rate hike isn't just a tool to combat inflation, it's an invitation to global and domestic investors to bring capital home. For years, Japanese savers seeking yield flooded overseas markets, particularly the United States, accumulating nearly $5 trillion in foreign assets. But in 2024, a major reversal began. Japanese investors bought 28 trillion yen worth of domestic JGBs in just 8 months, while slashing their purchases of foreign bonds, including US Treasuries, by half. If interest rate differentials widen further, this repatriation could accelerate dramatically. The real danger for the U.S. isn't just higher Japanese yields, it's the possibility of a sharply stronger yen. If the Federal Reserve reduces rates over 2025-2026 while Japan keeps tightening, the yen could surge as much as 10%, according to Morgan Stanley's forecast of USD, JPY returning to 140. In such a scenario, Japanese investors have no incentive to hold US Treasuries yielding 4% when currency losses could wipe out 6-7% of their returns. JGBs suddenly become the superior option, safer, domestic, and increasingly profitable. Meanwhile, Japan must strengthen the yen to contain inflation because the country imports nearly all its energy, 100% of its oil, 97% of its LNG, and 100% of its coal, all priced in dollars. A weak yen may benefit exporters temporarily, but skyrocketing import costs devastate households and industries dependent on foreign energy, making production more expensive and driving consumer spending downward. This threatens everything from Toyota and Honda production lines to Sony Electronics, PlayStations, anime studios, cosplay manufacturing, and countless small businesses. Therefore, Japan's survival strategy increasingly hinges on stabilizing and strengthening the yen. But as Japanese yields rise and the yen gains momentum, Western bond markets are beginning to unravel under the pressure. The US, Australia, Germany, and Spain are witnessing bond sell-offs, with yields climbing rapidly, especially the US 10-year and German Bund. Investors anticipate interest rate cuts across the G7, further diminishing returns and pushing capital toward Japan. The US is simultaneously confronting a dual crisis: the need for a weaker dollar to mask debt burdens and the necessity of lower interest rates. So American companies already struggling under loans at 8-10% can refinance. But economic data is worsening. U.S. factory activity has contracted at its fastest pace in 4 months. Demand is collapsing under tariffs. Orders are falling and PMI readings are slipping. If the trend continues, layoffs will follow, weakening America's industrial base until only AI data centers remain as the last major growth sector. The administration has few tools left. Reversing the trade war is politically impossible, leaving rate cuts as the only path forward. This is essentially a desperate gamble throwing policy spaghetti at the wall and hoping something sticks. Yet, Japan's sudden policy shift threatens to derail the entire U.S. playbook. Washington encouraged Japan to raise rates to strengthen the yen and avoid mass liquidation of U.S. Treasuries, but they failed to consider the unintended consequences. By creating a competitive Japanese bond market, they risk triggering a global rotation out of U.S. assets. If the yen truly enters a long-term reversal, Japanese investors, including pension funds and insurers, will rush back into domestic bonds to avoid currency volatility, especially as Japanese yields climb from below 1% to nearly 3%. We've already seen what happens when Japanese institutions overexpose themselves to U.S. Treasuries. In 2023, Norinchukin Bank lost $12 billion and was forced to dump U.S. bonds. With Japan now raising rates, no bank or insurer is eager to repeat that disaster. This is catastrophic for U.S. markets because Japanese investors have long been among the largest buyers of U.S. assets. Losing them would make it dramatically more expensive for the U.S. to borrow, not just for government spending, but for the entire $1.5 trillion capital requirement for upcoming AI data centers, which represents 20% of the entire investment-grade bond market. If Japan pulls its liquidity home, everything becomes more expensive: government borrowing, corporate refinancing, and even the future of AI infrastructure. Investors are already anticipating a stronger yen, as reflected in surging demand for 10-year JGBs even before the official rate hike. They are positioning early, which implies a simultaneous reduction in U.S. Treasury interest. When the BOJ hikes, and if the yen strengthens meaningfully, we could witness a massive capital exodus from the West. Japanese investors will likely move first, but Western funds may follow to escape a depreciating dollar. If this unfolds, U.S. markets could experience extreme volatility as a major pillar of global capital flows begins to shift direction. The coming months could be turbulent beyond anything seen since 2008. Let me know your thoughts. Will the Bank of Japan truly proceed with its rate hike? And if they do, how severe will the consequences be for the United States? Share your perspective and stay safe out there. And if you found this breakdown valuable, don't forget to hit like and subscribe as we continue navigating these extraordinary economic times together.